Hello and welcome to our webinar on stablecoins to scale, a compliance playbook after Genius and beyond. I'm Chris Boone, and I am joined with my colleague, Sophia Kielar, and we are going to provide a rundown on the Genius Act and how stablecoins are becoming intermingled and interwoven into the financial system, and how intermediaries, issuers, and digital asset service providers and other intermediaries in this space can comply with the expectations from regulators, the Genius Act, and so on, and looking forward to the future about how this will all kind of play out. So first, a little bit about us. As I said, I'm Christopher Boone. I've been with Venable for about 10 years in the financial services group with a focus on payments and particularly cryptocurrencies and stablecoins. And practice is pretty broad across all fields in terms of the movement of funds. And I'll let Sophia give a little bit of an introduction for herself.
Thank you, Chris. Hi, good afternoon. I'm Sophia Kielar. I'm an associate in Venable's Investigations and White Collar Group. My practice focuses on regulatory enforcement and particularly matters involving digital assets and financial technologies, and the intersection thereof with government enforcement investigations by the SEC, the CFTC, and the SEC, and DOJ.
So let's take a moment to go over the agenda. So here is our roadmap. We'll start with a quick refresher on what stablecoins are, how fiat-backed stablecoins work, and then we will cover the Genius Act at a high level, the rules for issuers and digital asset service providers, and also going over the kind of federal state split interplay that the Act creates. And then from there, we'll translate the law into a compliance playbook with specific controls that supervisors will expect in production. And then we will close by looking at anticipated rulemakings and some open questions, and also other bills that haven't been signed into law but could shape the structure of the market in other ways. So first, what are stablecoins? We get this kind of question a lot. Stablecoins are digital tokens, but they're designed to hold a steady value pegged to something else. Usually that something else is a currency, a fiat currency, most commonly the US dollar. So unlike Bitcoin or Ethereum, where the price will swing from day to day or minute to minute, sometimes quite dramatically, stable coins aim for predictability. It's in the name, stable coin, so that way users can interact and use it without having to worry about volatility. So the most common type, the one that dominates the market, are the fiat-backed stable coins. These are tokens where every unit that's issued is supposed to correspond to an actual dollar that is held in reserve. Today, Circle's USDC and Tether's USDT make up about 90% of this market. And that's reflecting both the scale and deep liquidity of some of these stable coins. The appeal of stable coins, you might ask, is you get speed, programmability, global reach without the price volatility that is introduced by traditional cryptocurrencies. In our experience, the top use cases that we're seeing include cross-border payments, remittances, merchant settlement. It can be used as collateral for DeFi applications. It can be used for treasury operations, and as a dollar substitute in countries where the local currency is unstable or experiencing high inflation. So how do the fiat-backed stablecoins work? So when a user wants a stablecoin, they will send fiat, let's say dollars for this example, to the issuer. The issuer will then mint a new stablecoin token and a one-to-one ratio, and then they'll credit that user's blockchain wallet with the token. And then the issuer receives the dollar, and then they hold that dollar in reserve or use it for a very narrow set of permitted um, investments, essentially, that are highly safe and liquid for purposes of redemption, because you want to be able to, when the customer wants to redeem the stablecoin for the dollar, to be able to quickly be able to redeem and make sure those users can have their funds, a very critical part of any system. The reserves are critical. So trusted issuers will hold these in these cash or highly liquid assets. These are typically short-term U.S. treasuries. Some can kind of go further and park the reserves in regulated structures like an SEC-registered money market funds and highly safe assets of that type. So, but what keeps the price at $1? Well, the whole idea is being able to redeem any outstanding token from the issuer for $1. Before now, previously, when this market was just first being kind of experimented with, when stablecoins were very new, we had these algorithmic stablecoins that didn't have 100% backing, that would have partial backing. And then they would use a type of market arbitrage in order to keep the price pegged at $1 by minting new tokens or eliminating some tokens to relieve certain market pressures. It was basically like mathematical wizardry. The problem was it didn't always work. And then when it didn't work, it was very, very, very bad. And so one of the kind of features of the Genius Act that we'll go into in a bit more detail in just a bit was this emphasis on having full 100% backed reserves. So now we're going to kind of transition into the regulatory landscape and an overview of the Genius Act. So the Genius Act was passed, it's signed into law, and it really does mark a milestone in the United States for digital asset regulation. It is a federally approved regulatory framework for US dollar-backed stablecoins. That has not existed before. And in addition to all the questions that it answers and the rules that it provides a green light, so to speak. It is a signal from the administration and from Congress that this is a type of technology that is innovative and we want to support and foster. Banks are traditionally very risk adverse. So up until this point, many banks who were not comfortable from a risk perspective engaging with stablecoins now have the ability to look further into this technology because of the essential backing of the government, that this is not just a fake mirage, but an actual financial instrument. But with that said, there are significant regulatory issues, compliance obligations that issuers will need to observe in order to be able to issue stablecoins in compliance with the act. So it's kind of a balancing act here. So first, one of kind of fundamental pieces of the Genius Act is that a payment stablecoin, as defined by the Act, is not considered a security or a commodity. And now that's a very important piece of information. It seems almost kind of obvious that it wouldn't be, but given the back and forth in the kind of jurisdictional tug of war that we've seen in the prior administration over how to regulate cryptocurrencies, it is actually very salient and appreciated to have this kind of clarity. So what are the key takeaways? Well, first, licensing is required. If you want to be an issuer, you are going to issue a stablecoin, then you will need to have a license to do so. This includes banks and non-banks. This also includes a potential state pathway, not entirely federal. In order for a company or a bank to issue stablecoin on the state level, the outstanding issuance of their stablecoins must be less than 10 billion in value. If it's less than 10 billion in value and the state where they're going to issue from has certified that their regulatory regime, subject to review and certification, is substantially similar to the federal regime, then that company would be able to issue under the under the state's regime. So you have this dual federal and state interplay that's kind of going on, which is an interesting approach, but it really does kind of foster the premise that there is a role both for states and the federal government in regulating issuers of stablecoins. And of course, we talked about the one-to-one reserve requirement. There is a redemption guarantee that is baked into that. If you are an issuer, you have to guarantee that a user will be able to redeem their stablecoin for the dollar. And if there are ever any issues being able to timely redeem a stablecoin, that issuer is going to run into some significant compliance issues and challenges. So a few other things that the Genius Act does is after 3 years from enactment, there will be a general prohibition on platforms being able to offer and sell stablecoins that have not been issued under this framework. So if there is a stablecoin, perhaps a foreign stablecoin, perhaps a local stablecoin, but those are being issued by a non-permitted issuer, essentially any issuer that is not a permitted issuer, that activity will be prohibited. Now there is I think 3 years is a pretty long time, especially in the crypto space, but that's going to be the law, so it's something to kind of keep in mind. Bankruptcy is a huge issue. What happens when a stablecoin issuer goes bankrupt? Well, ideally that wouldn't happen, but if it does happen, you have to plan for it. Well, under the Genius Act, the stablecoin holders have first priority. I mean, absolutely first priority. It's put in a bucket separate from the kind of general assets of the estate, if you will, of the company that is seeking bankruptcy protection. Another element of the Genius Act is a prohibition on leveraging the funds. These are the reserves. Essentially, reserves have to act like reserves. They can't be used for any other purpose other than for redemptions. There is a narrow slice of assets that the reserves can be parked. But anything beyond that would be in violation of the reserve requirements. There is a very kind of interesting story behind the SAB 121, and we won't get into all of it, but one of the things that Genius Act does is that it bars regulators from forcing custodians, those are individuals or entities that will hold stablecoins, from treating the stablecoin assets as liabilities. I'm not an accountant or economics guy, but I have been told and totally believe about how important that is for custodians. Now, digital asset service providers are mentioned and addressed in the Genius Act, but interestingly, there are not a huge number of requirements placed on digital asset service providers. The Genius Act is kind of narrow in its applicability to issuers and how the stablecoins themselves must be approached, handled, redeemed, and those sorts of aspects. When it comes to digital asset service providers, there are not really the same types of requirements. There isn't a licensing requirement or a registration requirement. What the Genius Act does say is that digital asset service providers are prohibited from offering and selling stable coins after 3 years that are not issued in compliance with this framework. And that will, I mean, if you're an exchange, if you are an off-ramp or on-ramp provider, and you use stable coins as part of your business, then this will be a very important provision for you. So we talked a bit about the federal-state kind of interaction. There really isn't a blanket preemption of state law in Genius, but there are elements that have preemptive effect. What's unique about Genius is its dual regulatory structure. States can opt in to certify that their regulatory regime is sufficiently substantial to the federal regime, and if a committee, which is the Fed, Treasury, and FDIC, certified that state regime is substantially similar to the federal regulatory structure, then that state can act as a regulator of stablecoin issuers. And stablecoin issuers can operate underneath that stablecoin regulatory structure by the state. That is, until they reach 10 billion in outstanding issued stablecoins. At that point, the regulator would switch from the state to the federal side of things. So when Genius was being enacted, there was a lot of debate about various aspects. One of those debates was about banks versus non-banks being allowed to issue stablecoins. Ultimately, the act decided on a more permissive approach where both banks and non-banks would be permitted to issue stablecoins. Critics argued that this would potentially let big tech issue private money, essentially, while proponents said that this would foster innovation. I'm not really going to speak on the merits of either side, but I will note that there is a kind of a compromise built into Genius there is a special rule for public non-financial companies where in order for a public non-financial company to be an issuer, to get approved, to get the license to be an issuer, they need unanimous consent from the certification committee, which is not typically the case. And the idea behind that provision was in some ways aimed at that exact issue, the worry about big tech issuing kind of private money and those types of concerns. The shot clock for application decisions also is being used to address a criticism that was lodged against the prior administration, where various agencies, rather than ruling on an application for various unrelated things, but within the crypto sphere, would essentially veto or block that entity from doing what it wanted to do, but there would be no decision to appeal because there would be no decision. They would just let the application die on the vine. The Genius Act contemplates a way to avoid this. If a regulator does not act on a licensing application, and within 120 days, the application will be deemed approved. So this is a strong accountability measure to prevent bureaucratic delays and potentially intentional feet dragging, so to speak. And at that, I will turn it over to Sophia to talk about building the compliance playbook.
Thanks, Chris. So now that we have this, overview and understanding of what Genius lays out and what it requires, and sort of what are the various controls that Genius contemplates, what would compliance look like in this sort of framework? What does compliance under Genius look like? So we break that down. Next slide, please, Chris. By first understanding the regulatory structures at play. Some of these are rather self-explanatory, like federal anti-money laundering laws and state money transmission laws that many of you are probably already familiar with and already having to abide by. This includes KYC and other such AML safeguards. In addition, a significant part of the Genius Act contemplates sanction compliance, so ensuring that sanctioned entities, sanctioned individuals, sanctioned countries are not interacting with whatever businesses might be subject to Genius. And of course, that is controlled by OFAC. Securities laws, well, as Chris mentioned, stablecoins are explicitly not securities or commodities, are not securities under, the Genius Act. The SEC does have some role to play, and those laws and those regulations would come from the Securities and Exchange Commission. Same too with the commodities and derivative sides of things with the CFTC. The banking side and the regulatory structure involved in that are quite robust throughout Genius. And we see various roles being assigned to the OCC, the FDIC, and the Fed. They contribute, for example, as Chris mentioned, with the OCC can issue non-bank charters for payment stablecoin issuers. And then more general regulatory and laws that might apply to unclaimed property, and very importantly, advertising and consumer protection. Consumer protection is an important part of almost the keystone part of almost every of these crypto bills being considered, and Genius does not leave it out either. And we'll touch on a bit more of the consumer protection side in the Clarity Act and other acts being considered in the market structure side of things at the end of the presentation. So what do regulators expect? And what are the industry standards that PPSI, so permitted stablecoin issuers, must uphold to, as well as what sort of supervisory expectations are there? First and foremost, there must be a risk management framework. That means integrating crypto activities into the larger enterprise-wide risk management. That means audit, compliance, and other programs that are robust and tailored to crypto. not siloing crypto in a separate part, being like, okay, let's forget about it. It's over there doing its crypto thing, but rather integrating the various other compliance, audit, and risk management controls that you would see in any other part of a business. Particular to that is having technological expertise on managing blockchain related risks rather just simply than relying on third party vendors. So having that in-house knowledge and expertise of what are the risks that we have to consider here, what are the various reserves that we have to be thinking about, and so on and so forth. And part of Genius is also these regular examinations that the supervisory regulators might subject payment stablecoin issuers to. So those examinations can include risk governance, like board oversight of crypto activities, as well as the controls that the company or the entity may have in place to manage risk, evaluating those risks, audit trails for those risks, the sort of transaction monitoring that would be expected to do such, as well as complying with the evolving regulatory guidance. Genius lays out a series of mandates to various regulators in the space, the OCC, the FDIC, the Fed, FinCEN, SEC, etc., to issue regulatory guidance over a series of milestones that we'll talk about a bit later, as well as just ongoing guidance and rulemaking on how to effectuate this act. So part of those examinations may include ensuring compliance with those later on issued regulatory guidances and rules. Chris? Thank you. So what do these controls look like? What are the actual programs and policies that would be helpful to effectuate these industry standards, as well as what the supervisors are looking for? First and foremost is ensuring safety and soundness in crypto activities, making sure that activities do not jeopardize capital, liquidity, or operational resilience. This is particularly important in the stablecoin space when considering and maintaining and safeguarding appropriate liquidity and balancing operational risks like prudent balance sheet exposure, not having risky investments on the balance sheet. In addition to the monitoring testing that we expect to see in robust BSA and AML frameworks, as well as the robust compliance and testing to make sure that sanction laws are being appropriately upheld. Like I mentioned before, making sure that sanctioned entities, sanctioned individuals, and sanctioned countries are not interacting with your framework. So that means crypto-specific transaction monitoring, customer due diligence, and suspicious activity reporting. And very importantly is third-party risk management. Like we talked about before, not just letting vendors do, having a vendor do XYZ and leaving them alone to do that thing, but rather, having in-depth and robust compliance policies and frameworks for vendors, including due diligence, contractual safeguards and oversight, and documentation of that. Slide, please, Chris. So some other controls that are equally important. Operational and cybersecurity controls. So what does that mean? Demonstrating to regulators and supervisors adequate blockchain transaction expertise. So like we mentioned before, not just shipping things out to outside vendors, but rather having an in-house knowledge and understanding of your risks, of your exposure to unique cyber threats to crypto, private key thefts, smart contract exploits, etc. Consumer disclosures are incredibly important in almost every crypto regulatory framework that we've seen, and protecting the consumer. So what does that mean? Transparency, prioritizing transparency, including fee structures and redemption rights, and using plain language requirements such that consumers have a full and complete understanding of any of their rights, as well as any fees or risks that they're exposed to. And one thing that people tend to not focus as much on is retention policies. In my own work, I've seen this be a really big discussion point with regulators of what sort of retention policies are in place to preserve communications and records for X period of years, depending on what you're subject to. And that includes informal messaging services that are incredibly common in crypto, like Discord, Signal, and Telegram. Being able to show to regulators that you have, like we mentioned with the third party risk management, that you had a conversation with them, that you've explained, that you've given them a contract about your policies and procedures to manage those risks, that your Telegram and your Signal chats are preserved for X number of years, that you can go and refer back to those and produce those if asked to do so. Next slide, please, Chris. So all these controls and policies are great, but there's also the reality of crypto, and crypto is unique in a lot of ways. Crypto is very much still seen as novel. Even as barriers drop, regulators remain extremely cautious and will scrutinize activities through standard safety, soundness, and compliance lenses. That mean that regulators are more hesitant to accept the status quo and will ask for a more thorough examination of things. Regulatory guidance is constantly evolving also in the crypto space faster than anything else we've seen for a given industry, especially because joint agency guidance is expected to provide clearer guardrails in the coming years, but we don't have that right now. And we've yet to see what enforcement looks like under Genius. And then there's the general increase in crypto adoption. Sort of why we're all here today. Crypto is experiencing a massive increase in mainstream adoption by both retail, consumers, and institutions. And with this growth comes the need to balance, regulatory compliance and safety with innovation, and keeping always in mind a culture of compliance and regulatory concern, while balancing that with the growth and innovation that comes with entering a new space, increasing customers, and operating under new regulatory frameworks. Next slide, please, Chris. So what are some practical steps for scaling? And you can do so exactly with the idea of that we're scaling safely with the innovation and the ability to build our businesses. First and foremost, it's translating these requirements and these industry standards and what supervisors are looking for into program artifacts, into actual written policies that proactively and diligently address these expectations, and codifying them and implementing them. Not just saying that you have them, but actually living that culture of compliance, which includes routinely conducting testing, maintaining testing records, honest board reporting, including disclosures of risks, asset reserves, and third-party involvement in management, as well as maintaining minutes. You might see this theme of the maintaining of records, and I cannot stress enough from my own experience with the regulators in general before the Genius environment of how important it is to have those records, and to be able to document that culture of compliance and these program artifacts. Now, like I mentioned before, that comes with balancing innovation and controls. So thinking through what matters most at launch versus long-term longevity and growth and maturity, and the constant involvement of compliance and legals teams in product and service development from inception through launch and later maintenance. It's an ongoing conversation with legal and compliance versus can I get a stamp of approval? Next, please, Chris. So what does this look like when you're trying to evidence your compliance to regulators and supervisors, as well as counterparties you may be interacting with? Written policies, training documentation, and proactive controls cannot be, I cannot underscore that enough. That means having written attestations and attendance records of various trainings and compliance trainings. Targeted training modules for different aspects of the business, for finance versus product versus customer-facing teams, including what sort of information and due diligence those various different teams might have to adhere to, as well as having a complex and written and thoughtful whistleblower policy. In addition to that, we want to think through having routine independent audits or testing that can be made available to regulators, investors, or counterparties if they ask for it. That shows being proactive and not hiding your cards. Clear roles and responsibilities of your officers and executives, your compliance officer or named risk officer, and audit liaison, and having all of these titles clearly defined, as well as real people behind them. Not just saying you have a compliance team, but rather that there's XYZ is leading that compliance team, that your risk officer is a real person that does XYZ job. Stress testing your liquidity and documentation of those test scenarios. That's especially important when we think about that um, excuse me, I skipped ahead. I was thinking about the public disclosure of reserve composition, especially when that comes to the stablecoin situation. The idea being that your reserves are public, that there's no concern that you cannot redeem, as Chris mentioned before, your stablecoin for the fiat currency. And then service level agreements that embed the Genius Act compliance clauses. Next, please, Chris. So, as I mentioned before, Genius lays out quite a few timelines and deadlines to consider for anticipated rulemaking guidance. It's very much not a bill that lays out everything, start to stop on what we can expect and what we need in the space, but rather has a series of deadlines that various regulators as well as state issuers might have to contribute to over the coming years. So first and foremost comes with the Treasury Advance Notice to implement Genius. And this is a very important thing for those of you out there that wish to have some sort of say in how Genius may be implemented. So last week, Treasury issued this advance notice of proposed rulemaking and is looking for comments on prohibitions on certain issuances and marketing, BSA, AML, and sanctions obligations, and the balancing of the state oversight with the federal oversight, like Chris mentioned before, this sort of tiered regime that we're working with. This is a great opportunity for those of you out there that wish to shape the evolving framework for payment stablecoins and also get out there the concerns that you may have. Comments are due very soon, in a month from now, about October 20th, 2025. Other things that are on the horizon under Genius. Like Chris mentioned before, there is the Stablecoin Certification Review Committee. And over the next year, from enactment, so by July of next year, hopefully, the committee must issue interpretive rulemaking on how non-financial public companies can be involved in the issuing of payment stablecoins. And this committee consists of the Treasury Secretary, the FDIC Chair, and the Federal Reserve Chair. And it has to be by unanimous vote that any non-financial public companies that wish to issue stablecoins are then granted that authority to do so. Like Chris mentioned before, this is a pretty unique situation that it requires, the heads of all three of the Treasury, the FDIC, and the Fed to unanimously approve. But it is the idea that this is a check on non-banks being involved in the payments space. The committee is also set to review which state frameworks are substantially similar to the federal regime and therefore would be approved for state issuers to allow. And then next year, we can also expect that Treasury, in consultation with the other agencies involved with Genius, will issue a report on non-payment stablecoins. So the utility tokens, governance tokens, algorithmic tokens, and how and where those might interact with the system. And lastly, but pretty importantly, is this pretty vague requirement in the Act for joint rulemaking on how to implement it. And we could think of this through the various regulators. So we're thinking the OCC, the Fed, FDIC, etc., as well as an interaction with the state regulators and state issuers to promulgate rules. And the Act is not super clear and specific, but we understand this to mean, based off of a larger context, on rules on capital liquidity and risk management, the standard for holding reserves and those reserve compositions. So what sort of reserves are allowed, how reserves are held, custody, the segregation of assets, the exact segregation of assets, and how things will exactly be reported and examined later on by regulators and supervisors. We can also anticipate seeing rulemaking on redemption policies and redemption procedures, specifically some rulemaking on foreign issuers and comparable regimes. The Act is pretty open right now to what those comparable regimes and the rules surrounding comparable foreign issuers might be, as well as the safe harbors for certain low volume circumstances. And one explicit thing in the Act is rulemaking on the prohibition of interest yielding. Currently, under Genius, interest-yielding stablecoins are not allowed, but there is a provision for rulemaking on what qualifies as generating interest and how far these programs can go and acting like a traditional bank that might grant you interest on like a savings account, for example. So looking forward, there are quite a few things on the horizon. We will be discussing the Clarity Act as well as some open questions under Genius and other larger crypto market structure bills. So some open questions under Genius that you might have heard as themes throughout what both Chris and I have said is this ambiguity around the dual regime. So the fact that, stable coins with 10 billion under circulation may be certified and issued by state issuers. But once they hit that threshold of 10 billion, then it's subject to federal review. So some uncertainty in the gray area of, well, what happens when you're at 9.7, 9.8, 10.2, 10.1, and sort of the transition between those two phases, as well as the extent to which federal rules may preempt state regimes. So, for example, the New York State DFS has the BIT license, Wyoming has its own regime, and the interplay between largely what we might see between federal and state, as well as what might be considered as substantially similar. There's currently a bit of ambiguity on whether state-issued stablecoins are allowed. For example, Wyoming again issued the FRNT coin, or discussions about it this summer. And then, of course, one thing that might be top of mind for a lot of people are any delay in rulemaking and agency actions due to federal staff shortages and the necessary challenges that come with any interagency coordination. As you can see, there are quite a few regulators that are involved in Genius in various aspects of it, and the Act does consider and mandate cooperation between these agencies for joint rulemaking. Handing it off to you, Chris, to talk about clarity.
Thank you. So we've talked a lot about Genius and stablecoins, but that is only a part of the greater kind of crypto revolution. The other half is the general market structure bills, plural, that are being considered for how to regulate cryptocurrency more generally. Now, this is primarily a debate between SEC regulation in the securities arena versus as a commodity by the CFTC. The Clarity Act was the House's version and the House's attempt at a market structure bill. It has passed the House and it is currently in the Senate under consideration, but the Senate is creating their own market structure bill. And we'll talk about the elements of the Senate's, at least the Senate Banking Committee's version. Senate Agriculture Committee has a side too, and that hasn't been released yet. But first we'll go into Clarity. So the approach that Clarity has taken is to define digital commodities versus securities. And if a thing is a digital commodity, then it is not a security. The SEC will retain jurisdiction over the contract, over the investment contract to the extent that there is one. For example, in an initial fundraising, like in an ICO. But the CFTC would regulate the digital commodities on the secondary market. So this attempts to resolve this long-standing jurisdictional tug of war between the SEC and the CFTC that we have seen kind of played out in the past. So the way that Clarity would work then is it would create a pathway for these investment contract type securities to be issued, to be offered without really the full SEC registration requirements for securities if they meet certain disclosure requirements. And then once a blockchain reaches maturity, and there's some questions over what that exactly means, the tokens themselves are treated as commodities. And as in terms of the disclosure regime, that will include things such as the tokenomics that are being contemplated, governance model, who is the team being led by and what their experience is, and the risks associated. So again, just to kind of re-emphasize, the CFTC would be given primary authority over the kind of cash spot markets for trading of the non-security cryptocurrencies. That's what we're calling digital commodities. And it establishes new registration categories for these entities. These would be digital commodity exchangers, digital commodity brokers, and digital commodity dealers, kind of mirroring those terms that had been used on the securities side. But now these will be under the CFTC's authority for digital assets that are not securities. And the kind of regulatory structure that comes with this include your traditional anti-money laundering, consumer protection, segregation of fund requirements, and also they would need to become registered members and futures associations. There is also a provisional registration that would be available, that would be implemented in the duration between enactment and when the CFTC implements its final rules, to kind of create a transition period and kind of smooth that kind of gray area zone a bit. There would also be a sort of kind of dual structure that contemplates a SEC registered firm dabbling, so to speak, in digital commodities, but without having to have dual registration. This is a kind of a tiered, capped approach. So if less than 25% of the trading volume is in digital commodities, then the SEC registered firm would not need to register with the CFTC as a digital commodity exchanger. And there are a few other kind of requirements. That was the simplified version, but it helps kind of streamline how entities in this space engage with their regulators in a way that kind of balances their need to be able to serve customers and innovate, and regulators need to ensure that consumers and investors are protected. And then finally, decentralized finance and infrastructure was given a kind of essentially a shout out in Clarity. So non-custodial actors, these would be like software developers, node validators, and some infrastructure providers in blockchain systems. Those would not be treated as financial intermediaries. They would not be treated as money transmitters, both under federal and state law. So this would preempt state money transmission laws to the extent that they are in conflict with this provision, if enacted. Now, that said, typically a non-custodial software developer, software provider would not be considered a money transmitter. But to ensure that remains the case, this provision was added to the act to protect that type of treatment. So going along with the kind of the preemption discussion, which is actually a really interesting way to kind of view these bills, is when a token is deemed a digital commodity under Clarity, that would be treated as a federally covered securities, even though it's a digital commodity and it's not a security. I mean, the Act says it's not a security, and so it's not subject to those requirements, but it is treated as a federally covered security. Now, what does that mean? Well, in effect, that means that it preempts state blue sky registration requirements. So it effectively is a kind of preemption lever, while even though it's not regulated as a security on the federal level. And then, as I kind of mentioned one slide prior, with regard to money transmission, the non-custodial developers and software providers will not be treated as money transmitters, preempting any inconsistent state law. Now, we give the Clarity Act a lot of time because it actually passed the House. That's a pretty big deal. But currently, the Responsible Financial Innovation Act appears to be the more likely vehicle to end up on the president's desk. The Senate is bifurcating this process. The Senate Banking Committee has released a discussion draft of their half, and this is an SEC-focused half of the bill. And the Agriculture Committee is going to release a CFTC-focused draft, hopefully soon. So the Senate draft discussion bill, it's SEC-focused, and it creates an ancillary asset category. Ancillary assets, what are those? What you're trying to picture in your head what that even means. They're not securities, but these would be tokens, digital assets that are issued alongside an investment contract. So the way to think about this, at least one way to think about this, is in the context of an ICO. You have a platform that releases a token, and the platform isn't fully developed yet, and they're raising funds to fund development of their platform. And so they sell the token. The token itself is an ancillary asset if it doesn't have certain qualities that would make it a security. But the sale, the offer itself, could still be an investment contract. And therefore, the token is then treated as an ancillary asset, which is not a security. And that becomes important for secondary offerings down the line. Similar to Clarity, also present in the Senate's discussion draft is very similar preemption of state money transmission applications as applied to non-controlling software developers and infrastructure providers. There is a list of what that really applies to. But in short, it's if you're not touching funds, if you're not moving funds for someone else, you're providing software, you're a node validator, that would not be considered money transmission. And that has been a theme we are seeing across both of these bills, which signifies how important to Congress that element is. And I just want to emphasize and highlight that as someone who works with money transmission laws very frequently. It's refreshing to see this being treated seriously. There also would be a micro innovation sandbox that would be kind of created, allowing some more flexibility for different approaches. And we don't really know exactly how that will frame up, but we'll be watching that carefully to see what comes out of it. I would also like to take a moment to give the CLE code. I think we are late with the CLE code. It is stablecoins, one word, 25. Capitalization does not matter. Stablecoins, 25. And so with that, I would like to give some closing thoughts. So I want to step back and look at the bigger picture. The Genius Act was the first time the US put a clear federal framework around fiat-backed stablecoins. So now issuers, custodians, intermediaries, banks that are supporting these intermediaries and custodians and issuers, they now all have a rule book that defines what it means to be compliant. That rule book is still being written, but it's there. And also, what happens if you fall outside the permitted paths? There is certainty where there was not certainty before. And so that is a very kind of important turning point that we just did not have previously, especially in the prior administration. But this is not just a compliance checklist. The act is an opportunity to reset how stablecoins are perceived, not just as experimental and volatile or risky, but as part of, or potentially as part of, mainstream financial infrastructure. At the same time, Genius raises nearly as many questions as it answers. We are patiently waiting for those answers to solidify and hoping regulators can meet their 1 year deadlines. Those are very aggressive deadlines. And I'm sure even after rules are issued, there'll be even more questions at the margins. And how those rules end up will determine how practical or restrictive this regime becomes. So looking at further ahead, the story also doesn't stop with a Genius. We talked about the Clarity Act. We talked about the Senate's Banking's Committee's draft. And if either of those are enacted, that will dramatically impact how the digital asset market evolves. And I guess just to say in plain words, this is a evolving and an exciting time to be in this space. And with that, we might have 1 or 2 minutes for questions. Sophia, if you had any concluding thoughts, you're welcome to share.
I was actually just scrolling through some of the questions that were submitted to us under the Q&A. Thank you for all of those that did submit. So Chris, one question we got was speaking a bit more on custody implications under Genius. Would you want to chat about that a little more?
So, I mean, custody is a tricky issue. Who holds custody will be significantly important for issuers, but it is also significantly important for any intermediary. So like which frame of reference is the kind of starting point for how that kind of question is answered. An issuer, in theory, can, has a couple choices for custody, self-custody or for example, a bank could potentially act as a service provider for custody. When making those choices, you have to be able to determine what is your own technical capability, what is your own security. Who is the other entity that is holding custody, and are they compliant? This goes back to third-party risk management, but it's multiplied because the risk if things go wrong is can be astronomical. All right. Well, we are 1 minute over. Thanks to everyone who joined. I hope you learned something new, and we're grateful and happy that you joined us.